Hello, I'm Samir Asif, Senior Partner at Regent Financial in New York and a former finance instructor at Stanford University. In the next half an hour, I want to do three things. First, I want to explain why the standard approach to valuing private capital is structurally wrong. Second, I'll introduce a framework called GLAV, General Equilibrium Liquidity Adjusted Valuation, that corrects the error. And finally, I'll walk you through a graduate course I've built around the framework. Now, the most dangerous phrase in finance is assume that the liquidity premium is constant. It is not a simplification. It is a mistake with measurable, correctable consequences for managing trillions in institutional capital. The phrase persists because for decades there has been no coherent alternative. For 3 decades, the secondary market discounts on private capital have swung from positive premia in booms to over 50% discount in crisis. No existing valuation theory predicts this. DCF, the discounted cash flow framework, treats this illiquidity as a constant. LAV, the liquidity adjusted valuation framework, treats it as a fixed adjustment. Acharya-Pedersen treats it as a covariance with a public liquidity factor. None of them get the empirical record. GLAV starts somewhere different. It treats liquidity not as a property of an asset, an investor, or a market, but as a state variable, jointly determined by every investor's exit decision. The illiquidity premium emerges endogenously from a stochastic mean field equilibrium over those decisions. It is, to my knowledge, the first complete general equilibrium theory of private capital valuation. And it recovers quantitatively the empirical record that 30 years of prior models could not. Now, I want to start with a simpler question. What is liquidity? It sounds elementary, but it is not. The word liquidity gets used in finance to mean at least 4 different things, and traditional finance treats it in private capital as a kind of fixed cost. GLAV treats it as something fundamentally different. The shift from the traditional view to the GLAV view is the single most important conceptual move in this course. So let me walk you through it carefully. Traditional finance has 4 overlapping but distinct ideas of liquidity. First is trading liquidity. The Amihud-Mendelssohn view. An asset is liquid if you can sell it without moving the price, measured by the bid-ask spread, the price impact, and the depth at the inside quote. This treats liquidity as a property of the market for an asset. The second is funding liquidity. The Brunnermeier-Pedersen view. An investor is liquid if they can meet their obligations as they come due, pay margin calls, fund redemptions, satisfy capital calls. This treats liquidity as a property of the investor. The third is market liquidity. In the macroeconomic sense, the financial stability view. Liquidity is ample or liquidity is tight, describes the aggregate availability of credit across the financial system. This treats liquidity as a property of the entire financial system. The fourth and most important or relevant for private markets is viewing liquidity as friction. The Philippou-Korteweg-Stafford view. Illiquidity is a friction. Investors require a premium to hold assets they cannot easily exit. This treats liquidity as a property of an asset class. Public equity is liquid. Private equity is illiquid. The premium is the compensation for the difference. All 4 are correct in their domains, but none of them individually captures what is actually going on in private capital markets. And critically, The standard DCF approach treats this fourth view, the illiquidity premium, as a fixed constant. 3 to 4% per year, layered on top of the public market discount rate, held constant for the fund's entire 10 to 12-year life. This is the move that fails, because empirically, the secondary market discount on private equity, it swings from positive premia in booms to over negative 50% in crisis. The implicit illiquidity premium is anything but constant. It moves with the market, it moves with the cycle, and it moves non-linearly in stress. The LAV framework starts from this empirical observation and rebuilds the theory. Under LAV, liquidity is not a property of an asset or an investor or even a market. Liquidity is a state variable, a single scalar that summarizes the condition of the entire private capital ecosystem at a moment in time. Call it L. Three features of this reframing matter. First, liquidity is stochastic, not constant, not deterministic. L evolves continuously and randomly over time. It mean reverts towards a long-run normal state, but it gets shocked by news, by cycles, and by collective behavior. It is modeled as an Ornstein-Uhlenbeck process with jump diffusion with the Levy process, much like the way interest rates are modeled in the Vasicek framework. Second, liquidity is collectively determined. L is not an exogenous parameter that the market hands to you. L is the outcome of every LP's exit decision, every GP's distribution policy, every secondary transaction. When many LPs simultaneously exit, they lower L for everyone. This is what economists call a mean field game. Each agent's optimal decision depends on the distribution of all agents' decisions. Liquidity, therefore, is endogenous to the collective. Third, the illiquidity premium is a function of the state, not a constant. It adjusts continuously to L. In a boom, the premium is small. In stress, the premium rises. In crisis, the premium rises non-linearly, accelerates, because crisis dynamics produce cascade effects that compound the friction. Hold that idea. Liquidity as a stochastic, collectively determined state variable, because it is the foundation of everything that follows in this course. The stakes are substantial. Private capital, including buyouts, infrastructure, real estate, private credit, and venture capital, collectively manage about $13 trillion. The largest holders are pension funds, sovereign wealth funds, endowments, insurers, and family offices. These institutions allocate based on valuations. Those valuations rest on an assumption that in some regimes is wrong by an order of magnitude. The downstream errors compound into capital adequacy, into pension fund ratios, and into retiree income. Three failures of DCF. The discounted cash flow and its close cousin, the constant premium LAV, fails in three specific ways. First, the liquidity illusion. Treating illiquidity premium as a constant when it varies systematically with market state. Second, the Jensen failure. Treating the discount rate as deterministic when it is stochastic. This introduces a convexity bias worth roughly 1 to 4% per year depending on asset class. Third, partial equilibrium. Treating each investor's decision as isolated when decisions are actually coupled through the secondary market. In stress, prices crash for everyone simultaneously, and DCF cannot see this. Let's take a look at the empirical evidence. Here is the secondary market discount graph on private equity positions over 30 years. The flat horizontal line at 0 is what DCF implies. The discount should be approximately constant. What we actually observe is the opposite. Discounts swing from a small premium in boom periods to over 50% during the global financial crisis. The same pattern recurred in 2020 and again in 2022. The Lazard pricing analysis quarterly reports give us this data. The variance is unambiguous. The discount is state dependent. GLAV is the framework that fixes all of the three failures. It sits at the top of a hierarchy. DCF is contained in LAV, which adds the Jensen correction. LAV is contained in liquidity adjusted CAPM, which adds the 4 liquidity betas from Acharya and Pedersen. The liquidity adjusted CAPM is contained in GLAV, which adds a stochastic state dependent premium and a mean field game equilibrium capturing collective dynamics. Each level, therefore, is a strict refinement. Set the new parameters to 0 and you recover the previous level. So GLAV is backward compatible with DCF, not a different theory, but it is a more complete one. Now, the state-dependent premium, let's have a look at the central object in the GLAV framework, which is the state-dependent illiquidity premium, which is pi of LT. Let me explain what each element in this equation means. L is the liquidity state of the market. It's a single scalar that summarizes where private capital markets are at any moment in time. Mechanically, L is calibrated from observable signals: the secondary market discount on private equity positions, the spread between buyout multiples and public market multiples, the volume of funds liquidity transactions, and a handful of macroeconomic indicators. L is centered so that L equals 0, corresponding to the long-run mean, a normal market. Positive L means a boom, negative L means market stress. L equals -1.5, corresponding to what was the global financial crisis, the GFC, back in 2008. T is the remaining horizon to the assets portfolio that's being valued. For example, a buyout fund that's 3 years into a 10-year life, for that, T would equal 7. For a venture capital position 6 years into a 10-year life, T equals 4. Horizon matters because illiquidity bites harder over longer holding periods. You can't simply discount an illiquid asset the same way, regardless of when its cash flows arrive. Pi, which is the output of the equation, is the annualized illiquidity premium that investors require to hold an asset given the current state L and the remaining horizon T. So, if pi equals 9%, investors are demanding 9 percentage points of additional yield per year above the public market benchmark, just to compensate them for being unable to exit at will at the current market equivalent price. Now, look at the right-hand side of the equation. There are 3 terms. First term is alpha of T. This is the baseline premium, the level of pi that would prevail if L were exactly 0, a market at its long-run liquidity state. Alpha is itself a function of T. Longer horizons require higher baseline compensation. Our central calibration sets alpha at around 4.5% for T equals 5 years, scaling up for longer maturities. Now, the second term is beta of T times L. Beta of T is the linear sensitivity of the premium to changes in L, again as a function of horizon. Beta is negative in our calibration, which makes intuitive sense. As L drops, as the market stresses, the premium investors demand goes up. The more negative L, the bigger the premium correction. The magnitude of beta tells you how quickly the premium responds to changing market conditions. Now the third term, gamma of t times L squared, this is the quadratic or convexity term. Gamma captures the fact that the premium rises non-linearly in stress. As L falls deeper into negative territory, the premium doesn't just rise, it accelerates. This is the mathematical signature of the GLAV framework, and it is essential. A linear model, which would represent pi of LT as alpha plus beta L alone, would understate the premium in all tail stress regimes. The quadratic gamma term is what produces the 4.31 times crisis amplification. I'll show you that in a couple of slides. Now, all three coefficients, alpha, beta, and gamma, are themselves smooth functions of horizon t. Now, we have not assumed, rough volatility in this case, because they would not be mathematically tractable. They're calibrated, these three coefficients, alpha, beta, and gamma, they're calibrated from secondary market data. And the calibration is empirically anchored. It matches observed secondary market discounts on private equity positions across the past 30 years, including the GFC, the 2020 COVID disruption, and the 2022 rate-driven repricing. Now, let's move to the table down below. When L equals plus half, it's a boom regime. Pi equals 3.5%, and it is below the long-run mean. When L is 0, long-run normal, pi equals 4.5%. The textbook constant premium DCF assumption sits right here. When L equals minus half, mild stress, pi is already 9.1%. That's double the normal state premium of 4.5%. A DCF model, assuming a constant 4.5% premium, misprices the assets by roughly 5 percentage points per year in this regime. Now, when L equals minus 1, we are looking into recession territory. Pi is 14.6%. Now, that's more than 3 times the normal premium. Moving further down, when L equals minus 1.5, that's the GFC equivalent, pi exceeds 21%, almost 5 times the normal state premium. This is the magnitude of variation that a constant premium model cannot represent and cannot accommodate. It is the empirical fact that motivates the entire framework. The quadratic curvature you see in this table, the way pi accelerates, not just rises as L falls, is the gamma term doing its work. Without that, you cannot match the data. Let's look at the results. There are 3 quantitative results predicted by GLAV and confirmed by the data. The first is the Jensen bias, which scales with horizon squared times return variance. For venture capital, 10-year horizon and 5% volatility, the bias is roughly 3.6% per year. For buyout, it's 1.6%. For private credit, 0.8%. These differences explain a substantial portion of the long-running PE alpha debate, because our implication is that a substantial share of VC alpha is actually the Jensen correction and not manager skill. Now, moving on to the second and third result. The second result is crisis amplification. When the liquidity state drops to GFC depth, GLAV predicts a valuation gap multiple of 4.31 relative to DCF. The empirical record matches. The third result is welfare. When investors ignore the externality of collective exits, the aggregate misallocation is roughly 2.3% per year on $13 trillion of AUM. That's about $300 billion annually. A property properly shaped Pigouvian tax closes roughly 3/4 of that gap. Now, that is the framework. Let's move on to the graduate finance course. 32 sessions across 7 units. The first 24 are a common core that covers diagnosis, mathematical bridges, and regulatory implementation. Sessions 25 through 31 split into 2 parallel tracks. Practitioners work in real cases like RGR Nabisco leverage buyout, while researchers focus on proving the existence and uniqueness of the equilibrium. So you see the common core section, and then the split track, and then finally you've got the capstone, that's session 32, where every student will present their project. Two-track design. You've got track 1 for the practitioners that assumes knowledge of basic stochastic calculus. And then we've got the second track for the researcher that assumes knowledge of partial differential equations and functional analysis. We will be deriving the HJB equation from first principles, the Makin-Vlasov existence proof, the Fokker-Planck, and the master equation, and more rigor around the Jensen bias and the theorems. So what would the students build? By end of the course, every student produces a complete liquidity adjusted valuation of a private market asset of their choosing. That is the term project. 8 Python notebooks reproduce every numerical result from the lectures. The midterm and weekly problem sets close the loop on the mathematics. The companion code is open. Every notebook runs in a browser, one click in Binder, no installation required. The library, the data, and the worked examples are all together. Practitioners can lift the code directly into their own analysis. For practitioners who want the production version of the framework, calibrated real-time with full portfolio support, the engine lives at liquidityillusion.com. Same mathematics scaled to institutional use. Course and engine reinforce one another. The course teaches the theory, the engine applies it. If you're a graduate student considering enrollment, the course site has the full syllabus, schedule, and reading list. If you're a practitioner evaluating the framework, the same site has all 8 notebooks ready to run. Thank you for watching. The course site URL is on the screen, drsamirasov-creator.github.io/ge-lav-course. I'll just give it a few seconds for you to note it down. If you have any questions, you are welcome to email me directly, drsamirasaf@gmail.com. I welcome your engagement, and thank you so much for your work, for the time. Thank you for watching.